Hi folks, welcome back to this video, second part of our comprehensive question. Now we're going to look at summarizing or posting to our T accounts in order to update the account balances from their opening balance to find ending balances. These ending balances will wind up on our financial statements. So let's begin. You'll remember in our question, we had given you some opening balances here for the company. All right. So for the company, they had opening balances for assets, liabilities, and shareholders' equity. So what we have to do now is use these as our opening balances for the start of 2014, which is January the 1st. So when we set up our T accounts, here you'll notice that the opening balance for cash, accounts receivable, supplies, etc., you'll see that we have those balances right here, the same numbers. So following that process, everywhere where you see 1/1/14, that's a January 1st, 2014 balance to open up the account balances for 2014 year. Because we journalized transactions in our Step 2 process of the accounting process, which was to record using the debit and credit framework, we post those debits and credits, to the T accounts in order to allow us to update the account balances. So for example, you'll see here in transaction A where we debited cash and credited accounts receivable for $50,000, you'll see our debit to cash is here and our credit to accounts receivable is here. We've even got a little reference here for you so you know it relates back to transaction A. We did that posting for each journal entry that we have. So now what we do is we come up with ending balances for each of the accounts that we have. You'll notice here for an account like cash, we added up all the debits and reduced it by the total dollar value of all of these credits. And that left us with a net debit balance of $1,286,500. Notice that cash, which is an asset, has a debit balance. The normal balance for any account is the side it would normally get bigger on. And assets get bigger on the left, and left means debit. So when we see that all of our assets have a debit balance, that should bring us some level of comfort because that should be its normal balance, meaning the side it gets bigger on. Accounts payable get bigger on the right. So what we would do here is we would add up all the credits and deduct the debits in order to get a net credit balance of $113,350. So for accounts payable, we know its balance is a credit balance, its ending balance that is, and that's because its normal balance is credit because that's the side it gets bigger on, the credit side, right? Similarly with unearned revenue and notes payable. Now, we have no activity in the contributed capital account or in the retained earnings account at this point. We did notice that during the year, we didn't have an opening balance for subscription revenue, licensing revenue, or any of our expense accounts, right? Their opening balances at January 1st, 2014 were zero. We know that to be the case because if we go back to our question, these were the only opening balances we had. They told us that in addition to these accounts, there were some accounts created this year or updated this year throughout 2014. So now we'll have balances for those accounts. You can see we created expenses, revenues during the period, and all of those accounts here have T accounts because we have to update the balances in those accounts. So now when we post the journal entries to these T accounts, you can see we move in our revenue accounts from zero balances to credit balances in our revenues. And again, A credit balance in a revenue account is what we would expect. Its normal balance for any revenue account is a credit because credit is the side that a revenue account gets bigger on, as opposed to expenses whose normal balances are debit because the debit side is the side that an expense account gets bigger on. Now we can take all of these ending balances, which we've conveniently double underlined for you, and put them in our statements. The first financial statement we would do is the income statement. Then we would do the statement of retained earnings and then the balance sheet. This question has asked us to do a little check before we do any financial statements to prove that the total dollar value of all of the debits and credits that we process throughout the month of January will leave us in a balanced position where the total dollar value of debits and credits is equal. That requirement means do an adjusted trial balance. So we will take all of those balances from our T accounts, which for our assets were all normal debit balances. We will look at our T account balances for all of our liability accounts and all of our equity accounts. And we will see these are our credit balances, but we can't forget our income statement account expenses. So we're going to add those or put those in our unadjusted trial balance and add them to the debit balances for assets, just to prove that the total dollar of all of the debits that we processed leaves us in a balanced position in that we are balanced with the total dollar value of all the credits that we processed. So we are now left with final balances in the unadjusted trial balance of $4,440,050. We can use the T accounts, or we could even use the unadjusted trial balance to come up with our income statement. So we know that on the income statement, we're going to include all of our revenues and expenses. So for Vanishing Games, the income statement for the 1 month ended January 31st, 2014, we present our revenues, which we know are subscription revenues and licensing revenues, total them, and deduct from this total our expenses, of which we have 3: salaries and wages, advertising, and utilities. Our total expenses that we will deduct from our revenues would be $393,350. That will leave us with an ending balance of not income, but a net loss. Why a loss? Because our expenses exceeded our revenues by $143,350. This is not unusual for a company that's just starting business. Normally, when a business is just beginning in its infancy, we find that expenses will sometimes be greater than revenues. We don't necessarily know the situation of Vanishing Games Corporation moving forward. Okay? We don't know when it started its business. We just know that these are the transactions that happened, and that in this particular case, it has a net loss. But if it is a company that's only, maybe 2 or 3 years into its business, it's not unusual that it may still experience losses. Don't let that concern you. All we're going to do when we do our statement of retained earnings for Vanishing Games Corporation for the month ended January 31st, 2014, is add that loss back to the opening retained earnings balance. And we can see from our question that our retained earnings had an opening balance of $1,419,700. So we're going to add in the loss. We did not have any dividends declared. If we had, we would have deducted dividends. And we now have retained earnings at the end of January 2014 of $1,276,350. This number here that I have highlighted is going to be on our balance sheet. So let's go prepare the balance sheet. But before we do, just a word. Notice that for the income statement, we have the who, company name, the what, the name of the statement, and the when for the month ended January 31st, 2014, because we're accumulating income, or in this case loss, just for the month. Statement of retained earnings is also for the month. It starts with the opening balance of retained earnings to begin that month and leads us to the ending balance of retained earnings at the end of that month. Now, if we do our balance sheet, don't forget we want to classify the balance sheet because we have some liabilities and assets, some of which are current and some non-current. So we're going to put the who, which is the name of the corporation, the what, which is the name of the balance sheet. This time it's going to be at a date. Why? At January 31st, because these are the balances in the balance sheet accounts at a single point in time. Once we start listing our assets, we always list our current assets first, of which we have 3. These balances, you'll notice, come from our T accounts, or you can merely take them from your unadjusted trial balance. You can pull them from here. You can also pull your equipment, building, and land balances for the non-current assets and all of your other balance sheet account balances, with the exception of retained earnings, not retained earnings yet, but with the exception of retained earnings, you can pull all of these account balances onto your balance sheet. Why? Because we haven't calculated at this point the ending balance of retained earnings yet. We haven't added in our income, or in our case loss, and deducted any dividends. So this is before we do the statement of retained earnings. But we can certainly take this equity account and all these liability accounts and see where we wind up. So now what you'll notice here is that we have cash, receivables, and supplies to get our total assets, and we have equipment, building, and land. If we take all these balances here from our trial balance, we're going to get total assets of $4,046,700. We also have current liabilities, accounts payable, and unearned revenue that total $186,850. Don't forget, we also had a long-term note payable. That's a non-current liability, $83,500. So we have total liabilities of $270,350. To that we will add our total shareholders' equity balance, which consists of our contributed capital, which we know is $2.5 million, and our retained earnings, which we get from our statement of retained earnings, not the trial balance that we saw earlier, but this comes from your statement of retained earnings. So now what we see is we have total shareholders' equity of $3,776,350, to which we will add our total liabilities to get a balanced position on the balance sheet of $4,046,700. Requirement 8 asks us to consider the income statement amount, which was a loss of $143,350, and ask us why it's not the same as the cash balance. Don't forget, the income statement is based on accrual accounting concepts, which includes revenue recognition, meaning that we record revenue when earned regardless of when cash is collected, and the matching principle, which says we record expenses when incurred to match the revenues being earned, regardless of when we pay the expense. So in our case, the cash balance, it would be highly coincidental that our cash balance would equal our income statement profit, or in our case loss, of $143,350 loss. Our cash is not the same as that because cash is calculated based on cash received less cash going out. But accrual-based accounting also looks at revenue earned and expenses incurred, regardless of when cash is received and cash paid out. Now, the new requirement was requirement 9. Was the company profitable for the period ending January 31st, 2014? The answer is no, because we know if we go back to the income statement, we have there a net loss of $143,350. So we would look to the income statement to tell us whether or not we're profitable. If we now go down to our third question, which financial statement shows the company's financial position? That would be the balance sheet, because it gives us the balances of all the assets, liabilities, and shareholders' equity accounts at one point in time. Now, are the company's assets financed mainly by creditors or shareholders? Well, let's go back and see where the amounts owing to creditors would show and the shareholder entitlement amounts would show. Creditor balances would show on the balance sheet as well as shareholder balances. So let's go have a look. In our case, we can see that our total liabilities are $270,000. Our shareholders' equity is much bigger at $3,776,350. So that tells us that our assets are financed largely by equity because shareholders' equity is bigger than our total liabilities. So this concludes our video on our comprehensive problem. I hope you found it helpful.